Hi, this is Jeffrey Cohen coming to you live from Highland Park, Illinois. I'm the president and CEO of U.S. Advanced Computing. Our service market is Chicago Quantum, and I'm here to talk today about our recent stock pick. Um, it was a great stock pick. I'm a little surprised at how good it was. So I'm going to talk to you about it, and I'm going to talk about why we think it worked. And we've done something. We changed our algorithm. We're going to talk about that a little bit. We're testing something new out. We'll talk about Intel. Intel fell on the floor today. I guess they had earnings last night, and so we'll talk about what that looks like. And yeah, let's walk you through the Medium article as well, real quick. So let's get going. What are we doing here? So we're going to start it off. Walk through the Medium article. Oh, look, my emails. This is what I see when I look at my publications, right? October 19, stock selection, oil and gas was actually, I didn't make any money writing this article, by the way. It's okay, though. At least 28 people viewed it, all from external. Most of them are from emails and a couple of LinkedIn's. You can see I'm not Jim Cramer yet, and maybe someday. So we picked PDC Energy, one company, right? They have about 3,000 oil wells in the United States, and they just make oil. They're E&P, exploration and production. Plus, we picked 134 stock volatility minimization portfolio. This is for the bigger picture people that want to look for, hey Jeff, what should I be investing in? And happy to share that with you. So we also suggest that you hold it evenly weighted, not capitalization weighted. It's a volatility minimization strategy, but we picked one big dog here, PDC Energy, right? So in the past, we've seen performance from our model hold for 25 trading days. We're in about 3 days here, and it's interesting. So what was interesting about this stock pick, very important, is we got the close data from the night before. We ran it overnight. We published it before the market opened. There was no PDCE doesn't have any overnight trading. So this was just raw, run the data, give you the pick. After we gave you the pick, actually we bought. And we've since liquidated our position, made a nice profit. I'm looking to get back in now. And so you can see how it's got some nice volatility there. You can get in and out. 134 stock portfolio reads like a who's who. This is nice. This shows you that our portfolio is kind of in the game, right? Adobe, ADP, Amgen, AMD. By the way, didn't pick Intel, which I have something really not nice I want to say about what happened to Intel. Lockheed Martin. It did have PDCE in it. It does have Paychex. It does have Qualcomm. Oh, look. It's got Google in there, I think. Yep, both stocks for Google. I mean, I just want you to know we picked some really good stocks here, and we didn't hand pick them. Occidental Petroleum, which, by the way, one of my favorites. We just let the model run. And so step 2 is we go deep within those 134 stocks to create a smaller, what I call the institutional investor list, where you can buy options. You can get in and out of the stock. See, we don't usually trade, but this stock was such a powerful pick from our model that we changed our Chicago Quantum Net Score Power, which is one of the fundamental levers in our model. And no matter what I changed it to, it still picked this one stock. Like, what's going on, right? And last week we picked AX and MCRB. Now, MCRB has been on a roller coaster ride. But what's interesting is AX and MCRB tend to move in opposite directions, zig and zag. And that's really the essence of our portfolio selection process is we can find the stocks and predict which ones will go up when the others go down. That's a big deal. So I'm still not telling you which way it's going to go. I'm just going to tell you it's a minimum. It minimizes the overall volatility of your portfolio. So those worked. Now I talk a little bit about PDCE. So we suggested you get in right around here. We bought as the market dropped a bit. Aw, too bad, right? So we got in low. By the way, we sold high. It was very nice. Made a few bucks. Point is, this thing is in a very flat upward trajectory, which seems to be what our model was looking for, right? Except it's looking for a full year data to figure out that this stock is poised for high return with minimum volatility. We look at it with the lines. One of the guys on our team is like, Jeff, how do you get those lines to work? Well, these are trend lines. And when you look at it, the trend is that this stock is going into a very tight pattern. And I find this very interesting, right? The moving averages, right? We're really tight here. And so this is a stock that's poised to not have a lot of volatility, to kind of ride in the range, but still go up with the market. So this actually inspired us to our next big research effort. So not only are we going to keep doing this, but we got a new potentially big announcement. We're actually going to roll that announcement out at IQT Europe next week. I'm not sure if any of you guys go to these quantum conferences, but we were honored that Lawrence Guzman invited us to present, and we don't pay for this, on quantum applications in financial services. And I'll be on the stage with God, I'm drawing a blank, and this was an old client of mine, a Dutch bank, very large bank. Oh, ABN AMRO. I'll be on the stage with ABN AMRO and another guy, another bank. Point is, we're going to be rolling this out. I'm actually making the PowerPoint or the keynote right now. So, but you see how this is like nice and flat. So nice, steady trajectory. So let's take a look at how PDC Energy did. And by the way, I don't look at stock tickers. I don't look at charts. We don't look at any of that stuff when we run our models. We run the model. Guess what? The model is what tells us what to do. This is the whole point. So we picked the stock on, what day was that? I just lost the page. That's awful. So I think it was Tuesday. It was Monday night. Monday night data for Tuesday morning. So when's Monday? Friday, Thursday, Wednesday, Tuesday, Monday. So Tuesday morning would be here. So we called it. You know, it was a little bit up. Probably right about there. Yeah, 355. So we called it around here. And the stock, of course, drops the next morning. Probably because we published our findings. And anytime somebody says good things about a stock, it usually like to shake out the bad guys. So, but we bought. Actually, we picked it at the bottom. Nice job, Jeffrey. We actually bought right around here. Cancel. Let's draw a picture. Because honestly, I see this. This is crazy stock right here. Oh, look at that. Nice upward trajectory. This is not guaranteed, people. And past performance is no indicator of future performance. But you look at this. This is just a steady climb. I mean, it dropped a little, went up a little, but this is a terrific stock to have in your portfolio. And we called it. We called it. We're happy. Made some money. Hopefully we made some of you money. And we didn't sell this stock pick, by the way. We did not offer this to any of our private clients. We just went straight out to you folks because we wanted you to have the best stock pick right before the market opened. And I got up very early that morning. I think I was at my desk by 6 a.m. Writing up the research, finishing the job so that you can have the stock pick. It's a nice pick. Made some good money, but that's not the point. The point isn't that we made money. point is that we found a stock that would move up with fairly minimum volatility. And this is when the price of oil had gone up. Now the price of oil has gone down today. So really this is a little bit of a play on the price of oil, but which is good. I want you to see what we got here, what we're picking for you. And so what did we do? What are we doing here? So I want to show you something else. It's actually very important. The S&P 500 has an ETF called the SPYder. Along came a spider, sat down beside her, eating their curds and whey, right? And so the SPYder, look over the year, right? It's got 300 billion in assets. This is the S&P 500, but you can buy this as an ETF. Change that up a bit. I mean, we can look at look at the MACD, right? I like to do this. This is you can see how there's good pressure here. So let's pull back and let's take a look. Zoom out. So the S&P should have the same shape as the overall market, right? You see you don't see March 1 year. Yeah, here you see it. You see the crash in March where it dropped, and then it has basically risen straight back up. So this is different than the S&P 500, which is the index. The S&P 500 is the index that you're not allowed to buy and sell. But what's interesting is it trails exactly, right? So I'm telling you what we did here. We actually, I'm going to save that. I'm going to put this in an article or something. This is interesting. So we've decided to replace in our model the index to $3,446.82, right, with just the SPYder. It's not perfect. If you zoom in, I can already see a couple of places where I'm not seeing the type of match that I would expect. You see that little spot right there? Oh, it didn't match. Didn't match. But in general, when you look at this index, it is matching pretty good. It comes back, right? It doesn't always match perfectly, but if you use the SPYder, sometimes it's a little less than the index, sometimes it's a little more than the index, seems to track. So I've decided that we would use the SPYder as opposed to the S&P 500 index to calculate beta. All right, now why did I do that? Because some of our clients may want to actually buy and hold the S&P 500, right? They might want to hold the SPYder, but to be an institutional trader and buy options on the index is a little bit tougher. There's two other of these that I think it's important to point out. There's IWM, which is the Russell 2000 ETF. I like pink for the Russell. And then you have QQQ, which is the ETF that Invesco has for the tech stock. So tech will make blue. So you take a look, and here's your indices. Now, these are good enough. They would track the underlying index, but there's something that you can buy. And so we substituted this in. The challenge is that the numbers are smaller. So the movement is smaller. And so what I'm finding is that the performance of our model has changed. I'm digging into this, and what we've actually done is we're retraining all of our solvers. Not the quantum one. That one actually does a great job, but the other ones, the classical ones, whether it's the genetic algorithm, simulated bifurcator, simulated annealer, Monte Carlo, how we work these guys together, the multi-start taboo sampler, and we're trying to figure out if your betas are lower because the numbers are smaller, then that means the changes in the market returns of stocks and portfolios is smaller. So my variance covariance of the portfolios is the same, but my expected returns across the board are smaller because the underlying value is smaller. So we got to think about that. Plus, the other thing I've noticed in running the model is that the actual market returns are down. So what's happened is maybe it's the comparison of a year ago, but market's not up as much. Yeah, this is about right. You have 47% up on the NASDAQ, 48%. If you look at the S&P, it's up 14. You look at the Russell, it's up 5. We floor and ceiling these things. We cap them, right? And so we cap at 20%, and we floor at 2.5. So 20 for the NASDAQ, 15 for the S&P, and 5 means 40 divided by 3 is 13.333 expected future return. So now I take betas that are compressed because I'm multiplying them in through the SPYder and not through the underlying index. Now my betas are lower. It's just interesting, right? Because you're comparing yourself to another stock. It just has a different effect. And yeah, so we're working very hard. We worked on this all yesterday, digging in, training our models to work even better, and then making sure we understand the differences. So that's there. So now I want to talk about something. So you take a look at Intel. This thing is called kurtosis. So when I started talking to people about, what is kurtosis, the first thing I heard was, Jeff, what, you have bad breath? You selling mouthwash? No, that's not kurtosis. That's this other word that means bad breath. And what is something to be skewed? Skewness. Is that like cuteness, like Furby, or what is it? So in math terms, you have 4 moments of stock prices, or movements, moments. The first is the mean, right? What's the stock price, right? What's it now? What's it in 5 minutes, right? Pretty easy to change. The second is, what's the variance? How much does it move? Does it move a lot? Does it move a little? If you look at Intel, it's got some nice variability there. It pops up and down, right? And so it's a second order effect. The third order effect is the skewness. So if you were to look at ups and downs, is there a predominance of one versus the other? Is there good news versus bad news? And so COVID testing probably has a skewness because it's pretty much all bad news. You go to get the test, it's bad news. You get the test result, but skewness could also be if I would have known that when I bid on the IPO of Google at $85 a share, and I probably could have gotten in at 150, but I was too greedy, and I said, you know what, I'm not overpaying the IPO price. I gotta tell this person I'll call him back. Hey, it's Jeffrey Cohen, Chicago Quantum. How can I help you? Oh, that's excellent. So you're interested in buying a couple of analyses. So which ones? Hang on, I'm gonna let you guys hear it, right? I got a possible customer here. So what you do is you go to our website, Chicago Quantum, you go to portfolio, and you see stock portfolios with reduced volatility and enhanced return expectations. So what happens is, for $150, this is what we recommend for new customers. You give us up to 64 stocks, and then you give us 10 optional extra stocks. We'll go in, we'll run them for you, and we'll give you the minimum portfolio. The second, if you look just to the right a little bit, for $250 to $750, who knows 64 tickers? Who knows 100 tickers, right? I'm lucky if I know one ticker, right? IBM, right? I don't know. So you could just tell us the exchanges you want us to run. we'll run every stock in the exchange that passes data validation. In this case, New York Stock Exchange, NASDAQ, and the New York Stock Exchange American, the B-tape, about 3,200 stocks, we'll run that for you. And so you pick it. That one's 750, right? Different ones have different prices. You might say, look, Mr. Cohen, I'd like 10 stocks in a portfolio. Add it to cart, 750, check out. It's a terrific opportunity for you to get your stock picks for the week. There's others though that don't want to do that, right? They have their own algorithms. They have their own portfolios. They're like, Jeff, maybe you could just help me with the coding of my algorithm on a quantum computer. And so that's fine. For $7,500, our team will code your algorithm ideas for a week. You're basically getting one full week's worth of effort across our team. So it's one person worth of effort, and we apply our skills and knowledge. We use our algorithms. You own the code at the end. And so for $7,500, you're in a great shape to then take your algorithm and start running it. Or you bring us back and you want to change it some more. And so you may have a completely different algorithm model. So I want to thank you. I'm going to let you make your purchase decision. If for whatever reason you want to look at the research, I know a lot of people do that. We posted our 134 stocks that we picked this week. You can take a look. We have presentations of our work. Here's some of the guys. We're on the phone all the time. We do a lot of slacking too. Here's the second paper and a discussion of it. Here's the first paper. And if you go into some of our videos, our YouTube channel, our Twitter, our ResearchGate, you're going to get a lot of information. All right, thank you very much. Let me know what you decide. Give me a quick email, and I'm happy to walk you through it step by step. Bye-bye now. Yeah, I hope that was okay. I love getting client calls. This is what we live for, right? And so now that I'm here at ResearchGate, we have our own lab. Jeffrey Cohen, Master of Management, U.S. Advanced Computing Infrastructure, Inc. out of Chicago. And so it's good. Right? We tried out the new D-Wave, the much larger D-Wave. We got 10 reads on that one. No one really cares, but the new D-Wave. 60 stocks. That mattered. 855 reads. Our first quantum stock pick, stock portfolios. 40 stocks. There's a lot here. And then I got to give a shout out to Clark Alexander and Alex Kahn, members of the lab, members of the team. Those are associates. We have 3 other researchers that we've onboarded. So let me go back to Intel. That's funny. That call wasn't planned, but it's nice that it happened. So we take a look at this stock, and you see that why isn't it showing it here? I don't know what it's doing. There it is. The stock basically fell on the floor. The expression I want to use is a little more colorful, but and I don't know if you guys know the expression of a dead cat bounce, but that's what this is. A stock overnight crash. Oh look, it went up. It went up. By the way, even a cat that gets thrown off a skyscraper bounces as it hits the pavement. It's called a dead cat bounce. It's still dead, but for that moment when you look, it just jumps up a little bit, right? Because it rebounds. And there's your dead cat bounce right there. So anyone who got in and said, oh, I want to jump in at 48.55, basically just lost that money. Now, if it comes up tomorrow, you're in better shape. But this is a dead cat bounce. Do not, please save your money. No dead cat bounces. Wait for the stock to move and kind of settle into the new position there. It's very rare that a stock will drop like this and then immediately come back. Dead cat bounce. Don't do it. I got to tell you, just please, don't do this. Let me see if I can draw it. I'm going to doodle on it. This is a dead cat bounce. Never, never, never. I want you to say it 3 times. I will never count on a dead cat bounce. Thank you. So, but the question is, if you looked at Intel over the past, I don't know, couple of months here, or a couple of weeks, couple of days, would you call a drop like that? Well, maybe you would. Take a look. It dropped on the toilet when COVID hit. It went from 60 to 48. And the fact that it dropped again from 50 something, 53, 54 to 48 shows it's possible. And so we are going to use quantum computers to look for the higher order movements of stocks. So I can't really see skewness in this data, right? It's hard to envision, right? But it goes up more than it goes down. It goes up a lot and it goes up often, much more often than it goes down. A Poisson distribution is very, very skewed, but even just a stock, right? If it's more likely to go up than down. And then this other one is fat-tailed movements, large stock movements that are, let's say, more than 2, more than 3 standard deviations away from the normal move. So if the normal move on Intel is a penny or 5 cents on average move is a penny, 1 standard deviation, 2/3 of the time it's maybe 3 cents, 2 standard deviations it's maybe 6 cents, 8 cents, 3 standard deviations is 10 cents. That's 996 out of 1,000. But how often is it gonna, it's gonna have that? And so what we could do is we could run models, and this is research, so we don't know how to do it yet, but we're going to learn on how to predict skewness and kurtosis and any other of the higher order movements on stocks. And we're going to run them on quantum computers and we're going to deliver them to you, in addition to the existing product and service that we have today. And so I'm proud to make that announcement. You're probably like, that doesn't sound like very exciting at all. Well, it is to us. The other thing I want to talk about is a second product, or second idea, which is a continuation of previous research, which is quantum walks on graphs. So we know how to build a quantum walk simply, a simple quantum walk, or a quantum walk on a simple graph. But we'd like a more generalizable way to do quantum walks on graphs on general graphs. It's very difficult. These are discrete walks. These are binary walks. This is not continuous. The math's a little tougher. And we want to bring to you an application, a financial services application for quantum walks on graphs. So right now we have the 2 service areas that we're looking into from a research perspective. One is kurtosis, or the higher order movements of stocks, the second, third, fourth, fifth, sixth derivative of a stock movement, and using a quantum computer to do that. And a quantum walks on graphs, finding a business or market opportunity for that. So I want to thank you for listening. Oh boy, I have a message in there. Hi, Junaid Javed. So, COVID-19 has disturbed every poor people. He's worried about the Pakistani poor people. I am also worried about the poor people of the United States of America. I love the United States of America. I don't know if you know, but I'm running for office. Javed. It's too bad you're not a U.S. citizen, or I'd ask you to vote. Jeffrey Cohen, clean water. I care about the American people. I care about you having clean water. So guess what? You go help out the people in Pakistan. I'm going to help out the people in Lake County. The poor, the hungry, the people without clean water. I'm going to help them. I'm going to help you. If you're watching, if you're in the United States, I'm going to help you. I'm going to bring you clean water if I win this election. The election ends November 3rd, so people are voting right now. This is a very important time. So I'm going to thank our friend here, Javed. Thank you, Junaid Javed. I also care about clean water. and hope you can take care of the people of Pakistan. El Presidente. While I care for the great people of Illinois. I love the people of Illinois. I just want you to know that. So, what else was I going to show you? This is kind of interesting. So let's take a look at PDCE again. Stock's coming down. I can't wait. If this stock comes down, my buy point again would be around 12, 12 and a quarter. So I'm not expecting a chance to get back in. In fact, I think this thing's going to sail away and I'm just going to lose the chance to buy. But if it drops, I'm coming in again. I love the stock. I just want to talk a little bit about PDCE, things I didn't know about when the model picked it. Insiders own almost 8%. Institutionals own 83.5%. You add that up, that's 92%. 92% inside ownership. There's 100 million shares outstanding. Got a nice float there, 9% float. That puts upward pressure on the stock. The short float is actually equal to all the shares that are not owned by institutional investors or insiders. Now, gross margin on making oil makes sense, 96%. So if they can produce a lot of oil or the price of oil goes up, that number drives through the roof. This is a terrific, terrific opportunity. I can't think of a better pure play on a stock than I can right here. Current ratio, 0.8. So their current assets don't quite cover the current liabilities. Not great. Probably got to raise some more money, right? If the price of oil doesn't go up too much, they're probably in trouble, right? Look at this. Earnings per share this year, down 1,000%. They lost money, but they still got the oil wells. Almost 3,000 oil wells in the United States. And heavy institutional holdings. People want the exposure to E&P. And this is a tough business right now, right? Because the price of oil has dropped. In fact, Jeffrey, how much has the price of oil dropped? I can't believe Intel, by the way. Oh my goodness. Price of oil has been floating around 40 bucks for a while. Let's take a look. Now this is a December 2020. See, the price has been up 43, 39. Price has been down 36. That's pretty flat, pretty regular, right around 40 bucks. And so the question now is if I'm making 96% gross margin, it means my cost per barrel of oil is about $2, right? But then there's all the overhead costs. There's the executive costs. There's pensions. There's shipping, pipelines, any kind of post-processing. And so the price of oil goes up $1, assuming they don't have really, really heavy hedges in place. They make $1. It goes up $2, they make an extra $2 on every barrel of oil they produce over their 3,000 wells. It's nice leverage. So I can buy the oil future, or I can buy the stock and take advantage of the management team's hard work. So just wanted to show you that one. Now I want to show you a stock screener. So how did I find Intel? So let's go into it. You come into Yahoo Finance. By the way, I love Yahoo Finance. I love Yahoo. Let me just say it. Great. So I've got one called Big Hairy Losers. You come in. So my change in price has to be more than a 4% move, -4. It's a U.S. stock, mid cap to large cap to mega cap. And I don't want stocks that are trading like 1,000 shares, right? Because that happens. This is 1,000, a million. This is 10 million shares. So let's take a look. Let's edit. Let's change something. What else do I care about? I also want to see big movements like this. Stock price. I don't want penny stocks. I do not want penny stocks. So I look at price, and today is greater than $2 a share. I got 5 stocks. It's not a lot of stocks. So I got Intel down 11%. I got Virgin Galactic Holdings. That's just a weird space company. I don't know. Down 7%. You look over here and you see that Intel is actually dancing around its 52-week low, as is American Airlines Group. Now, it makes sense. American Airlines is an airline. They might drop. People aren't flying. They're afraid of COVID. But who's Jinko Solar Holdings and who's Fastly? I don't know. But it's interesting when an Intel shows up in a chart like this, because it makes you wonder what's going on. And the fact that they had a disappointing quarter, you would think that 11% of the entire value of the company, look at this, the stock is worth $204 billion. They lost $25 billion on the day in market cap. That's an incredibly large amount of money. And then you saw what happened. Price of Intel drops through the roof. Clear up the drawings. Goodbye. 5-day. 1 day. Again, I'm going to ask you to please don't catch a falling knife. Look at that. They got lost. Sheep led to slaughter. And so, who knows where the stock's going to go? Could go straight, could recover, could drop more. We don't know. But what we do know is this movement right here, up and down movement, is crazy. This is a crazy movement right here. And so if we could predict the next big move of a stock, right, like this, kurtosis. Kurtosis. And we believe we can train a quantum computer to do this. And this is our assignment. So thank you very much for listening. I just wanted to share with you guys, keep you current, keep you in the loop, and we'll talk to you later. Bye-bye now. And remember, if you want more information, I guess I can't stop for a second here. If you want more information, go to chicagoquantum.com. Pretty fast read. You can buy our stock picks. You can buy custom project services. You could learn just a ton about the market. We have a pretty active blog that we keep up. And go ahead and visit. Let us know what you think. All right. Take care now. Bye-bye.